783. That's not a random number, that's the exact tonnage of registered silver, the metal standing and ready for immediate delivery, that vanished from the vaults of the COMEX in the last 5 trading days. Not projected, not estimated, actual metal, gone from the ledger as of this morning. And if you think this is just another day in the metals market, just noise for the silver bugs, I need you to listen with absolute clarity to what I'm about to show you. Because while the financial media was fixated on earnings reports and Fed speakers, the foundational plumbing of the global commodity system began to groan under pressure it hasn't faced in over a decade. This isn't speculation. This is documented warehouse data, delivery notices, and shipping manifests, numbers you can pull yourself from exchange websites. By the time we finish here, you will understand the precise mechanism now in motion, why it was inevitable, and most critically, what it signals for the months ahead. Because there is a pattern here, an architectural flaw that surfaces every single time faith in paper promises meets the uncompromising reality of physical weight. Same triggers, same warning signals, same explosive repricing, and we are witnessing the trigger sequence activate in real time. The only question is whether you will see it as a structural event or dismiss it as market static. Stay with me, because the next 15 minutes will permanently change how you view price, value, and the very definition of liquidity. Global financial liquidity, as measured by global broad money supply, just contracted for the 4th consecutive quarter. That's the first time that has happened in the modern fiat era. Not a slowdown, a contraction. The system is draining. At the same time, the collective demand for physical precious metals from central banks, not ETFs, not futures, but bullion bars, hit a 55-year high in 2024, a trend accelerating into this year. 2 lines on a chart, moving in opposite directions with violent purpose. But here is the data point nobody connects. This exact divergence has happened before, 3 times in the last century. And each time, the ensuing volatility didn't just shake the commodity markets. It exposed a fatal disconnect between paper claims and tangible assets, leading to a regulatory or systemic reset. Not similar events, identical blueprints, same phases, same actors, same outcome. The process is logistical, predictable, and once a certain inventory threshold is breached, unstoppable. Let me show you the engine. Every major commodity dislocation of the modern era, from silver in 1980 to oil in 2008 to nickel in 2022, followed a precise 4-phase sequence. It is a playbook written in warehouse receipts and margin calls. Phase 1, the accumulation phase. A physical asset is abundant, cheap to store, and financially suppressed. A large strategic buyer, or cohort of them, begins a systematic, quiet acquisition of the physical material. Not the futures, the metal itself. They place it in secure private vaults, often outside the major exchange systems. Capital is patient. The paper market, saturated with derivatives, shows little movement. The world perceives no change. This phase can last for years. Phase 2, the divergence phase. The physical inventory in the official exchange-sanctioned warehouses, the visible supply, begins a steady, persistent decline. Month after month, the registered stock falls. Yet the paper price remains strangely subdued, held in check by massive short interest in algorithmic trading. A gap opens. The premium for immediate physical possession over the paper price begins to creep up. Insiders pay it without complaint. The public market, watching the flat price chart, sees nothing amiss. Confidence in the paper pricing mechanism remains absolute. This stage typically lasts 18 to 36 months. Phase 3, the delivery signal. This is the critical pivot. A market participant, often an industrial user fearing shortage or a financial player with a strategic mandate, does the unthinkable. They stand for delivery on a large block of futures contracts. They do not roll them forward. They do not cash settle. They demand the metal. This action pulls visible inventory down another critical step. Other holders, seeing this, begin to mimic the behavior. Delivery notices spike. The exchange's warrant system, the system of ownership receipts, becomes strained. The paper market, a palace of leverage, suddenly requires a foundation of real stuff. And there isn't enough. This phase unfolds over 2 to 5 months. Phase 4, the structural repricing. The paper market and physical market, forcibly married by delivery demands, violently reconcile. The price either explodes upward to destroy the short paper claims, or the exchange intervenes to halt trading, cancel contracts, and break the link, destroying its own credibility. Liquidity evaporates in the paper world, while the physical asset becomes virtually unobtainable at any price. The trusted pricing benchmark is broken, sometimes forever. Now, let me prove this pattern is not theory with 3 historical examples. 3 different commodities, 3 eras, the same exact script. 1979, 1980. The Hunt brothers in silver. This is the folklore everyone gets wrong. The narrative is of two wealthy speculators trying to corner a market. The reality is a masterclass in the four phases. Phase 1, accumulation. Beginning in the early 1970s, the Hunt family, recognizing the disconnect between flat money and tangible assets, began quietly accumulating physical silver, not just buying futures, acquiring coins, bars, and bullion. They stored it. By 1979, they, alongside a consortium of allied investors, held an estimated 100+ million ounces of physical metal. The COMEX warehouse data showed gradual draws, but the price had moved only modestly. Stage 1, complete. Phase 2, divergence. Through 1978 and 1979, visible exchange inventories fell by over 50%. Industrial demand was strong, yet the large commercial banks and traders on the COMEX maintained massive short positions in paper silver, believing the price would stay low. The premium for a bag of silver coins over the spot price began to widen significantly. The Hunts continued to take delivery on futures contracts, pulling more metal out of the system. The data was clear. Supply was leaving the price-setting exchange. The shorts ignored it, confident in their financial power to roll contracts indefinitely. Stage 2, verified. Phase 3, the delivery signal. In early 1979, the Hunts and their partners stopped rolling. They stood for delivery on a staggering portion of the COMEX futures market. They demanded the metal promised by the contracts. The exchange, seeing its registered stocks plummet towards zero, panicked. They changed the rules. They imposed liquidation-only trading, meaning you could only sell to close positions, not buy to open new ones. They raised margin requirements to astronomical levels. This was the admission. The paper system could not meet its physical obligations. Stage 3, documented. Phase 4, structural repricing. The price, freed from the constant downward pressure of unlimited paper shorting, exploded. It rocketed from around $6 an ounce in early 1979 to a peak of $54 in January 1980. This wasn't hype. It was the market discovering the true scarcity price. The system's response was not to admit the physical shortage, but to crush the buyers. The rule changes and margin hikes forced the long side to liquidate. The price collapsed. But the lesson was etched in stone. When delivery is demanded, the paper price is a fiction until proven otherwise by metal. The credibility of the exchange was permanently tarnished. Stage 4, complete. 2007, 2008, the crude oil super spike. Everyone remembers $147 a barrel. Everyone blames speculators. Almost no one understands the delivery mechanism that made it inevitable. Phase 1, accumulation. In the mid-2000s, the global growth story, particularly from China, was clear. Strategic players and some sovereign wealth funds began to accumulate physical oil, not through frantic futures buying, but through long-term supply contracts, investments in storage tankers and infrastructure. The physical market was tightening. Phase 2, divergence. Throughout 2007, global oil inventories began a consistent draw. The futures curve shifted into backwardation, where near-term oil is more expensive than oil later, a classic sign of immediate physical tightness. Yet, the dominant narrative was that high prices would destroy demand. Major Wall Street banks maintained trading positions that relied on this thesis. The physical market screamed scarcity. The paper trader narrative screamed bubble. Stage 2, check. Phase 3, the delivery signal. In the spring of 2008, as the July futures contract approached expiry, a critical mass of holders decided to take delivery at Cushing, Oklahoma, the delivery point for WTI crude. Why? Because the physical oil in storage there was more valuable than a cash-settled promise. Tank farms at Cushing filled to near capacity with oil that was spoken for, not available for the next claimant. The paper market, which had allowed virtually unlimited trading of paper barrels, suddenly faced a shortage of wet barrels at the specific delivery point. The mechanism of delivery forced convergence. Stage 3 verified. Phase 4, structural repricing. The price didn't just rise, it went parabolic, spiking to $147 in July 2008. This was not mere speculation. It was the price required to balance immediate physical possession against a mountain of paper claims. The subsequent crash was due to a demand collapse from the great financial crisis, but the spike itself was a delivery point squeeze made manifest. The system nearly broke. Stage 4, complete. The London Metal Exchange nickel crisis. The most recent, purest example. Phase 1, accumulation. Jingshan Holding Group, a Chinese nickel giant, had built a massive short position in nickel futures, betting the price would fall. On the other side, a consortium of producers and perhaps strategic holders saw the physical market tightening due to supply chain issues and the geopolitical shock of the Ukraine war. Russia is a major nickel producer. Physical nickel inventory in LME warehouses had been in a steady multi-year decline. Stage 1. Phase 2, divergence. The LME registered nickel stocks fell to perilously low levels, less than a day's worth of global consumption. The price began to rise, but Tsingshan's enormous short position held, believing it could be rolled or managed. The physical premium for certain nickel forms skyrocketed, while the LME paper price lagged, creating a massive arbitrage gap. The system was begging for a correction. Stage 2, check. Phase 3, the delivery signal. As the price rose in early March 2022, margin calls hit Tsingshan. To meet them, they would need to either buy back their shorts, pushing price higher, or deliver metal. They could not deliver the metal because the specific form of nickel required for LME delivery was precisely what was in short supply. Other market participants, smelling blood, bought futures and stood for delivery, knowing the cupboard was bare. On March 7th, the buy orders flooded in. The market moved to enforce delivery. Stage 3, documented. Phase 4, structural repricing. On March 8th, nickel price doubled in a matter of hours from around $30,000 to over $100,000 per ton. It was a margin call of apocalyptic proportions for the short side. The LME, to prevent a cascade of broker defaults, did the unthinkable. They canceled all trades done that day. They broke the market to save the system. They chose to destroy their 145-year reputation for trust rather than allow the delivery mechanism to reveal the true market clearing price. It was the ultimate admission that the paper contract had become untethered from reality. Stage 4, verified. 3 commodities, 3 decades, same 4-phase pattern, same catastrophic failure of paper to meet physical. Now, let me show you why the silver market entered Phase 3 last Tuesday. 1946, the U.S. government held over 3 billion ounces of silver in its strategic stockpile. It was money, it was industry, it was security. By 1970, that stockpile was nearly gone, sold off or leased into the market. The era of abundance was over. The market adapted, creating a paper superstructure to facilitate trading without moving metal. Fast forward. 2004, the first U.S. silver ETF, SLV, was launched, creating a new paper claim on the metal. It grew and grew and grew. At its peak, the ETF and similar products claimed to represent over 2 billion ounces of silver, a stunning number. But here's the critical, overlooked fact. The entire above-ground investable stock of silver bullion in the world is estimated to be around 2 to 3 billion ounces. The paper market had created claims on a significant fraction of all the silver that physically existed in bars. Stage 1, the stage for divergence, was set not by accumulation this time, but by the proliferation of paper claims against a finite physical base. Now, watch the divergence. 2020 registered COMEX silver, approximately 150 million ounces. Today, as I record this, 32 million ounces, an 80% drawdown, not over a century, in 4 years. During the same period, the price, while volatile, traded in a broad range between $18 and $30. It did not reflect an 80% depletion of the deliverable stockpile. Meanwhile, the premium you pay to buy a physical silver eagle coin from the U.S. Mint over the spot price has consistently traded between 25% and 40% for 2 years. That is a sustained wide divergence. The physical market is saying one price, the paper market is quoting another. Industrial demand, electronics, solar panels, automotive, has hit record highs 4 years running. Mine supply is flat. Recycling is static. The deficit between new supply and total demand is measured in the hundreds of millions of ounces annually. Where is it coming from? It is coming from the only available reservoir, the vaults. Stage 2, verified, mathematical, and glaringly obvious. Now, here is the ignition sequence. Stage 3, the delivery signal. Last week, a single entity or a aligned group took delivery of 783 contracts on the COMEX. That is 3.9 million ounces of silver. In 1 week, that is not a roll, that is a withdrawal. It coincided with a similar, larger withdrawal from a major silver ETF, where shares were redeemed for metal. This is not retail buying a few coins. This is institutional scale physical acquisition. It is the equivalent of turning in your bank IOU and asking for cash from the teller. And the teller's drawer is looking light. Why now? Because the strategic landscape has shifted. The Bretton Woods system is fragmenting. Nations are repatriating gold. The dollar's hegemony is being questioned, not rhetorically, but in trade settlements. In this environment, what is the ultimate form of financial insurance? Not a digit in a bank account subject to capital controls, not a bond subject to devaluation. It is a tangible, dense, recognizable, historically permanent asset that sits outside the banking system. Silver, alongside gold, is that asset. The smart money is not buying call options. It is taking delivery. It is converting financial assets into non-financial, non-counterparty risk assets. Check. Stage 3 is active. Let me tell you what phase 4 looks like, based on the pattern, based on logistics, based on the simple mathematics of depleting vaults. The paper price will either have to rise violently to a level that convinces enough holders of physical metal to part with it, which could be a very high number, or the exchange will face a failed delivery. A failed delivery is a nuclear event for a futures exchange. It means a contract is broken. To avoid this, the exchange will do what it always does, change the rules. They will increase margins exponentially, they will impose position limits, they will force the longs to liquidate. They will, in essence, defend the paper short status quo by breaking the buyers. This will create a moment of extreme volatility, a potential waterfall down in the paper price, even as the physical metal becomes impossible to find. This is the paradox. The spot price on your screen could crash, while the coin shop's door is locked with an out-of-stock sign. This is the moment when the two worlds fully decouple. Savings evaporate for those holding paper proxies that cannot access the metal. Opportunities are created for those who understood the split was coming. Now, I know what you're thinking, but the COMEX has infinite paper. They can always create a new contract. The banks are too powerful. They will never let it squeeze. Let me tell you something. History screams. The Hunts were the richest men in America. They were crushed by rule changes. The LME was the pillar of the industrial metals world. It canceled trades to save shorts. The system always protects itself, but each time it does, it loses more credibility. Each time, more participants lose faith in the paper benchmark. Each time, more capital flows into the direct physical hold. The system isn't defending against a price, it's defending against the revelation of its own fragility. And you cannot print credibility. You cannot engineer trust. Once the delivery mechanism is proven faulty, the entire pricing edifice becomes suspect. That is the real collapse, not of a price, but of a belief system. But the Fed can provide infinite liquidity. They'll backstop everything. They printed infinite money in 2008 and 2020. They absolutely did. And where did that liquidity go? Into financial assets, stocks, bonds, real estate. It inflated the paper wealth of those who owned them. It did not create more copper, more lithium, more silver in the ground. In fact, by debasing the currency, it made the real, tangible stuff, the things you can hold that are not someone else's liability, relatively more valuable. The Fed's printing press is a tool for the financial economy. It is powerless over the physical one. You cannot print a barrel of oil. You cannot print an ounce of silver. You can only print more claims to them, which, if overdone, simply makes the physical asset flee from the claim. Every empire believes its financial ingenuity can overcome resource constraints. They are always wrong. The pattern doesn't care about narratives or central bank omnipotence.